everyone, Luke Gromen, FFTT. Hope everybody is well and had a great weekend. Before I jump into this week's edition, wanted to give a quick shout out to Mary Chapman, Tree Ring subscriber, and finally got to meet her face to face last weekend. Unfortunately, at sad circumstances at the funeral of a dear friend of both of ours, father. But it's great catching up with you, Mary. Very nice to meet you in person. So with that, I'm going to jump right in. First question's from Heine. Any warning signs to look for the next Fed pivot? Will they even disclose if they don't shrink the balance sheet and just keep printing irrespective of rates? In my opinion, the warning signs will come from debt markets. If issuance begins to dry up, basically if markets get too volatile, issuance begins to dry up, that'll be one warning sign. I think volatility in equity markets, another warning sign, and we've started to see that a bit, of course, with equities selling off, volatility rising. And I think the biggest one, as we've talked about before, is U.S. Treasury market liquidity, or illiquidity, as it were. You've already had some tremors in volatility. You've had tremors in U.S. Treasury illiquidity. We wrote about that a little bit last week. Not a lot, but a little bit. You've also had, I'm told, a little bit of illiquidity or a little bit of softness in debt market issuance in the last week or two. Nothing huge yet, but something to keep an eye on as a signpost. So I think the last one will probably be the yield curve. If you get a yield curve inversion, that I think will be another big warning sign. So those are the things I'm watching, along with the dollar and some other things in terms of the big ones, at least in terms of when we start thinking about timing of a potential Fed reversal or relenting on their tightening program. From Laura, any chance the U.S. is the sovereign? You mentioned in your Friday letter that's secretly buying gold. I was highlighting a report or an article in Bloomberg by Eddie Vandervelde talking about a sovereign whale buying gold every time it falls below $1,800 per ounce over the last year and a half. And Laura then goes on to ask, if you can freely print money, doesn't it make sense to secretly accumulate gold with printed money till the jig is up? To me, it's possible. It would make sense. I agree with you on that. However, in my opinion, it's unlikely. Just the risk is that if word got out that the United States government was buying gold, number one, from a policy standpoint, the people in Washington, many of the policymakers in Washington at Treasury, etc., are so dogmatic about the dollar. Ditto the Fed. I just think that it's like a religion for them. They're not gonna do that, even though it's probably the smart thing to do given the fiscal situation. In my opinion, more likely that sovereign in question in the Bloomberg article was Russia or China, and obviously we've seen those trends over the last decade or so. From Bruno, what are your thoughts about long treasuries, the long treasury, the bond curve steepening, which is desired, promoted by the Fed against the current need, although not quite possible to hike short rates? They need the long end of the curve to rise as much as possible so that they can hike rates without inverting the curve, but they can't let the long end rise so much that it begins to hurt the real economy. Because really the 10-year treasury is really the policy rate for a lot of the real economy through the housing link, consumer lending link, more broadly. And so you're already seeing the economy slow a bit per the Atlanta Fed's data, other data. In theory, the Fed can manage the curve by selling off part of the long bonds that they own. And in theory, steepen the curve in that fashion, and they might even try to. And it would probably work given some of the Treasury market liquidity we just talked about a second ago. All of this implies that the Fed can judge both the non-recessionary level of long-dated Treasury yields on a lag ahead of time, and what the economy is doing in real time better than the bond market and the yield curve can judge that. And in my opinion, both of those are pretty tough asks of the Fed. So we'll see. But in theory, they have some flexibility to manage the long end based on the fact that they own bonds that they can sell into an increasingly illiquid, at least relative to history, Treasury market. From PM, how can inflation possibly persist into the summer when QE is ending, rates are already up, stimulus checks have likely run out, supply chains are improving, and base effects are in place? Well, base effects were in place in the second half of last year too, and that didn't help. So we'll take the last one first. I think supply chains are probably the key swing factor to watch. They are improving seasonally in particular. They're always really busy in 4Q and not so busy in 1Q, just given the consumer heavy nature of America, consumer spending nature of America and GDP. So it is definitely improvement, particularly in the last several weeks. We'll see if it continues to improve. Inflation at this point, I think, depends very heavily on that continued improvement. Supply chains depend very heavily on China. And I think China and how well they play along depend in no small part on how much the State Department, the U.S. State Department, keeps picking a fight with China. Every time that, something I've been watching, every time we hear the State Department talk about Xinjiang, rightly or wrongly, or Taiwan, you got to believe that there's going to be some sort of retaliation. And one of the easiest ways, one of the most plausibly deniable ways for retaliation for China is to figure out a way to just delay the improvement in supply chains. Whoops, we found 2 COVID cases in Ningbo. Got to shut the port down for 2 weeks. That's going to back everything up. Shutting a port for 2 weeks is going to back up things for 2, 3, 4 months. So, given the elaborate nature of supply chain. So, long-winded way of saying is supply chains will improve as long as China doesn't weaponize them. And State Department is giving China a lot of excuse to weaponize them. We can agree, disagree, but it's a weapon China can use, particularly knowing that stagflation is the Fed's worst nightmare right now. And so weaponizing supply chains will be a very effective weapon against the Fed, against the Biden administration. The last thing they need for midterms is stagflation. Now, if the economy goes into recession, you're likely to get inflation to roll over, but that's going to create a whole new set of problems that still very few people are talking about. You're going to have debt market problems. You're going to have Western sovereign debt market problems in a sustained recession. And Western sovereign debt will be at risk of nominal default, including Treasury bonds, in a sustained recession. And so I think it is highly unlikely that we will see Western sovereign debt put at risk of nominal default. And instead, what we will see is Western central banks reverse course, begin buying more of the sovereign debt, re-upping QE in order to maintain the nominal solvency of Western sovereign debt. And I think as the public, particularly the next iteration of this movie, whether it happens in 2 months, whether it happens in 6 months, whether it happens in a year, I would take the under on a year. As the public sees this, now that the public has seen a 7.5% CPI print, we're into a very dangerous part of the game for the Fed, which is the next time they have to relent, people are going to start factoring that into their business models, into their mindset. Okay, the last time the Fed did this, we did end up getting inflation. Let's raise prices. Let's get ahead of it this time. So it could really begin to feed on itself, which is, I think, the Fed's worst nightmare. But ultimately, if they didn't want this problem, we shouldn't have done what we did economically. We shouldn't have issued all the debt. We shouldn't have gone to war in the Middle East. These mistakes, while in the short run have no cost, the debt in the short run has no cost. In the long run, it always has a cost, and it's very steep. I think regarding the mindset getting set, I think policymakers know this. I think they know that, and that's why they're getting so panic-stricken about inflation in the last several months. From DM, Kathy Wood says, when China catches a cold, commodities catch the flu. She believes the housing bubble in China is bursting. Please explain why you believe this won't crash commodities. It could. It could. That said, what Kathy and what most of the rest of Wall Street are missing, which is something I just alluded to, is that China catching a cold and giving commodities the flu will also put the global economy into a recession. And it's going to put sovereign debt, and in particular Western sovereign debt, at risk of defaulting, as in your coupon payment for German bunds, U.S. Treasury bonds is not coming this month. We don't have the tax receipts. I don't think that's going to happen. I think given the choice between that and Fed, we need you to print the difference, the answer will be Fed, we need you to print the difference. Fed prints the difference. And so to me, this bigger meta dynamic, if you will, is likely to provide, I'm not saying there's no downside to commodities, but I think it's going to provide a floor on a structural secular basis over this cycle for commodities, for industrials, for gold, for Bitcoin, in my opinion. I think it's important to recognize or remember, I think it was Mark Faber who said unemployment was 95% in Zimbabwe when they hyperinflated. And so there's this mindset that, we can't have high rates of inflation unless we have high rates or low rates of unemployment, or if we, and that's just not true. Once you get to high levels of sovereign debt, things start to get a little weird. Now, I don't think the United States or any Western sovereign is going to become Zimbabwe. That's not my point. My point is extremes inform the means, and the United States had currency depreciation-induced inflation throughout the 1970s, and I think that's where we're headed again. And so that's where I think Kathy's wrong on this, and much of Wall Street. They're just not factoring in where we are in the long cycle in terms of U.S. debt in particular, U.S. deficits in particular, given that the United States is the center of the system. Sovereigns aren't going to let themselves default. And if things roll over toward a recession, that puts all of them at risk of default. From Patrick Johnson. Luke, very happy FFTT subscriber here. Thank you very much, Patrick. Appreciate your business. In your opinion, what's your preferred vehicles for gold exposure? Coins, gold miner, politically friendly countries, GLD, Fizz. For me personally, I like physical bullion coins held out of the system, so private vaulting. A number of cities have them around you. You have to look into it a little bit, so I don't know what's in your particular city. I prefer gold eagles and Canadian maple leafs. I also think miners in politically friendly climates, and which is to say, U.S., Canada, and I just caught myself there. This is the risk of miners, right? Ultimately, the risk of miners, we have this long-standing tradition of political friendliness in the Anglo-American countries. Did what Trudeau just did last week change that as it relates to gold miners? I don't know. But I do know I have to actually think about that for the first time. And so I'm not saying I dislike Canadian miner, any of those. All I'm saying is the political situation can change rapidly. It is appearing to change rapidly, possibly. So let's just pay attention, right? Let's watch. So, like I said, holding physical gold coins out of the system doesn't matter what Trudeau does or anybody else. So I think that's that's I think critical to watch. What does all that mean? Look, if we go back to some sort of gold revaluation, is it possible that the Trudeau administration would say, listen, gold miners, you're going to get the first $5,000 per ounce of upside, and anything after that we're going to take? Yeah, absolutely. Now, will gold miners be happy if, from a financial standpoint, if that's how it were to play out? Yeah, the dividends on gold miners at that point will be bigger than the share price today in all likelihood, or close to it, right? So they're going to be just fine. But what it would point to is that gold miners, in my opinion, gold miners in the Western countries may not be the most levered way to play at this cycle, because we're at the end of a sovereign debt cycle, which was not the case in the 1970s. So it's just something to think about. I'm not telling people to go out and sell all their gold miners, anything like that. I just think when you start seeing things like we just saw in Canada in the last 2 weeks, you have to think about sovereign risk in a way that maybe you hadn't before. I know I am. Let's see here. Jesse, hi Luke, can you please elaborate on what a revaluing of the dollar price of gold would look like and how it would work exactly? If you can comment on the potential geopolitical implications of such a move, that would also be greatly appreciated. So the mechanics are actually straightforward and provided for in the Fed operating manual. It's online. Treasury instructs Fed to revalue gold. Fed revalues gold higher, effectively using the printing press. Doing so creates a deposit in the Treasury general account at the Fed for the U.S. Treasury. And so 261 million ounces means that roughly every $4,000 in gold's price puts $1 trillion free and clear into the Treasury's account that they can spend however they see fit directly into the economy without an offsetting increase in the U.S. debt. So just for round math, 40,000 an ounce, 10 trillion, spend 10 trillion into the economy and infrastructure and education, whatever you want to do. Hopefully they use it productively. Good luck. $10 trillion into a $22 trillion economy. You're growing GDP by 40%. There's no debt increasing on the other side. You're going to have a significant delevering of the U.S. government's balance sheet. And at that point, the Fed can then normalize interest rates without blowing up the system. So mechanically, that's how it works. From a geopolitical standpoint, it would be enormous. You would basically it'd be the U.S. government de facto admitting or transitioning to the system that Russia, China, Europe, basically all of Eurasia has been moving toward for the last 20 years, really since the launch of the euro, which is gold is the primary reserve asset, not treasuries anymore. And what that would mean is that basically either the U.S. government would have to shrink itself or the Fed would have to print the difference. And if the Fed prints the difference, then you're going to have inflation. You're going to have the dollar not be the strongest or the cleanest dirty shirt. It's going to be the dirtiest dirty shirt because we have the biggest deficits for our central bank to finance relative to any other deficits. So the short version is you would have, it would basically be a de facto change in the global currency system. It would be a restructuring of global reserve status, a reserve system. The dollar would still be a reserve currency, but the primary reserve asset would be gold, not dollars. In short, I think you would have the biggest global economic boom in 80 years, since after the aftermath of World War II. In broad strokes, the nations that have been driving consumption, like the U.S., would see big increases in domestic production, reshoring, because the currency would fall. It would make it attractive to do that. They would need to do that. And vice versa, those that have been driving a lot of production, the Chinese in particular, to a lesser extent the Japanese and the Germans, would have to consume more. Their currencies would rise against the dollar. Their products would get less competitive versus the U.S.'s. So that's sort of the big thrusts, and then you can sort of take it a lot longer than that. But I'll pause there. I'll stop there. Those would be the implications. Let's see. From BC, how could the Cayman Islands be one of the biggest buyers of treasuries? Is it Tether or someone else? Yeah, Cayman Islands, population 62,000, it now owns, hundreds of billions of treasuries. I want to say over $200 billion in treasuries, and they're, I think, the sixth largest foreign creditor of the United States. How's that happen? It's hedge funds. The Caymans are a proxy for hedge funds. And it raises an important contextual point that, again, most investors on Wall Street are just ignoring because they haven't had to think about who and how the U.S. deficits are financed for 50 years. The U.S. has gone from the biggest marginal buyer of treasuries, biggest marginal foreign buyer of treasuries being foreign central banks in 2014, which is a very stable creditor. Then after 2014, when foreign central banks basically stopped growing their holdings of treasuries, it moved to the global private sector, right? So you're talking about Japanese, German insurers and pension funds, not quite as stable as central banks in terms of credit, but still really stable. Now the biggest marginal buyers of treasuries on the foreign side, according to the U.S. Treasury's own foreign holders of treasuries report, Luxembourg, Ireland, Cayman, UK, Switzerland, right? So I called them the ULICs. UK, Luxembourg, Ireland, Cayman, Switzerland. So the UK, they're a twin deficit nation. They're not recycling surpluses with the US into treasuries. They're twin deficits. They don't have surpluses. So that's a financialized sector. Luxembourg, tax haven. Ireland, tax haven. Caymans, hedge funds / tax havens. Switzerland, funds and tax havens. So the U.S. government is increasingly financing itself more and more at shorter and shorter durations. Over the last several years, they've actually raised the duration a bit in the last 4 to 6 months. But with increasingly fickle creditors. And what this means is hedge funds don't care about politics. They don't care about relative currency stability. They want to make money. And so for whatever reason, they stop making money on their treasuries, they sell. This is very different than when central banks were holding treasuries, where there were politics, relative currency values that came into place, trade surpluses, a whole lot more that made them much more stable. Basically, what it translates to is the treasury market's going to be more volatile than it ever was every time we have a market sell-off, a crisis, because hedge funds are going to be selling a lot, and they're now a big part of the financing of the U.S. government. What that then means is the Treasury or the Fed's probably going to have to step in much sooner in crises to continue to allow the Treasury market to function properly. And if you recall, the Treasury market started seeing dysfunction in March of 2020, and we've written about the Fed's shadow third mandate, maintaining Treasury market functioning. Okay, a couple more here. Michael, do you believe that bank accounts across the West will be shut off in response to dissenting views? I'd like to say no, emphatically, but I can't. I think what happened in Canada last week, if it hasn't gotten your attention, it should. As an investor, quite frankly, for my wealth, I am far more interested in what's happening in Canada, particularly vis-a-vis the banking system, than I am in Ukraine. I remember taking my shoes off at the airport in 2005 or 4 or 6 or whatever. That was going to be temporary too. It wasn't temporary. So the one thing I will say without getting too political here, central bank digital currencies will facilitate this dynamic tremendously, where you tweet something wrong, you have wrong think, to use a 1984 term, or to make up my own. Central bank digital currencies will make it much easier for the financial system to be weaponized against its own citizens. And so I'll stop there. From Mark McGuire, odds of Russia going into Ukraine, odds of recession this year. I'm not the right guy to talk to on Russia and Ukraine. The only thing I will say is I don't know why Putin would do so. He's winning. He's been fighting to have Nord Stream 2 into Germany for 20 years. It's basically done. They're about to turn it on. The U.S. has said we will sanction Nord Stream 2 if they go in. My view, that's euro-denominated energy. It gets Europe away from the dollar. It gets, for their energy bill, it gets Russia further away from the dollar in their energy exports. And so I just don't know why he'd push it, but we'll see. Odds of recession, I think, depend very much on if the Fed actually hikes and sells bonds or not. If they don't, then I think the odds of recession are pretty low. I think if they do, the odds of recession are pretty high. And so I think that's why it's really key to watch. Will they, and watch for those signals we talked about earlier about whether or if, when they might relent. All right, last two. E.g., what's the status of Basel III net stable funding ratio regarding gold? There was a sense that by January 22 there would be some uncertainty with the implementation. Haven't heard anything about it for some time. Nothing burger. Is it a nothing burger? Backing up, net stable funding ratio for gold under Basel basically was enforcing, seemed to be codifying the wind down of the unallocated gold market in London. It was making it more expensive, unattractive economically for London banks to hold large amounts of unallocated gold as opposed to physical and allocated gold amounts. And so you wind down the gold leverage, it ultimately should start showing up in gold's price. In other words, instead of leverage rising in London and gold price not rising, leverage stops rising in London, gold's price rises. The language within that net stable funding ratio was watered down last July. With that said, I don't want to make too much of the last 5 or 6 weeks, but gold has been remarkably resilient in the face of rising real rates, rising nominal rates. Given what real rates have done, gold could easily be $300, $400, $500 lower than where it is today. Probably should be, but isn't. In fact, it's up. And so directionally, even with the watered down language, the same dynamics seem to be in place. I don't want to make too much of it, but I think it's very noteworthy that gold's not collapsing under this rise in rates. So let's see if it continues, but I think that may actually be a sign that this net stable funding ratio thing is actually having a positive impact on the gold price. So let's watch and see. And then the last question from TJ, what would you rather get paid in? A, Bitcoin, B, gold, C, a gold-backed currency. Why? I'd rather get paid in dollars. I get paid in dollars, then I can pay what I have to in taxes without having to convert back into dollars. I can pay my interest payments on investments, property, etc. in dollars. And then I can convert the rest into gold, Bitcoin, industrial commodity equities, and real estate as I see fit. So for me, it's just about the liquidity. And I think it's really where you're seeing the system evolve to, right? You get the currency you get paid in. I won't say it doesn't matter, but it kind of doesn't matter. It's where you store any surpluses you generate. And I think the system, as I talked about before, has been evolving for much of the last decade, from a system where you store your surpluses in treasury bonds to storing your surpluses in gold, Bitcoin, equities, real estate, because sovereigns cannot abide positive real interest rates. They will go broke under real interest rates given their debt loads. And storing your wealth, sovereign debt that has a negative real interest rate, only a fool would do that. And I'm not a fool, and neither are you. So with that said, thank you everyone for joining. We ran a little long today. Appreciate you checking us out. As always, if you like these updates, check out FFTT-LLC.com for more information about what we're up to and our Tree Rings product, 10 most interesting things, quick synopsis, reviewing world events for either ways that they are interesting or confirming or denying the lens we're looking at the world through. And with that, I will sign off for today. Everybody, have a great rest of your week. Take care.